Our accounting session, and today what we will be looking at is limited companies and published accounts of those limited companies. Now we have reached the final topic in our accounting course that we were looking at, called Special Aspects in Financial Accounting. And we are now at published accounts of the limited companies, and in this session what we'll be looking at are the guidelines for accounts for external users as stipulated by the Companies Act, and also the preparation of income statements, profit and loss or the profit and loss accounts, and statement of financial position, or what persons will call the balance sheet, in a form suitable for publication. Now, what are published accounts? These are the financial statements that a company must issue every year and which are prepared in a format suitable for publication. And when I say format suitable for publication, it is usually in a condensed format. We are accustomed preparing financial statements like our income statement, statement of changes in equity, and also the statement of financial position. And when we do our income statement for a company, we normally have sales minus our sales returns. Then we have, which give us our net sales. And then we usually move on to our less cost of goods sold. And in previous accounting courses, we were taught how to calculate cost of goods sold, which is the basic format is usually your opening inventory, add your purchases minus your closing inventory. And then that gives you your cost of goods sold subtracted from your sales will usually give you your gross profit. And then we will move on to add any additional income that the business would have earned during the year outside of their sales revenue, which will give us our gross income. And after that, we will then subtract all our expenses from that gross income, which will usually give us our net profit before taxes. And then we will take away our taxes, which will give us our net profit after taxes. And then we will go into our statement of changes in equity. Now, we will not, when we are preparing the income statement for publication, we will not go through that long format that I just described, but we will do it in a condensed form, and we will speak about that later in this video. Now, who are the users of published accounts? Some users of our published accounts are shareholders, prospective investors, debenture holders, the creditors or our suppliers, financial analysts, and the financial press. So these are some persons who would usually look at the published accounts. What should our published accounts comprise of? Section 239 of the Companies Act 1989, and this is according to the UK Companies Act, states that the company's account should comprise of the following. First, it should have the company's profit and loss account, or their income statement and balance sheet, or what we call the statement of financial position. So the account should have in that. They should have the director's report, 3, the auditor's report, and 4, group accounts where applicable. So where it is applicable, you would have group accounts. Now in this, when we go to demonstrate our question, we're not going to be getting into preparing a director's report, auditor's report, and all of those things. But what we'll just be preparing is our income statement, statement of financial position, and statement of changes in equity. Some accounting principles that are associated with our published accounts, and we would have been through accounting principles and concepts previously. So we expect that persons should be familiar already with some of these accounting concepts and principles. However, items shown in the company's accounts are determined by the following. Firstly, the company is presumed to be a going concern. So the company is usually presumed to be a going concern. The accounting policies are applied consistently from one financial year to the next, and the amounts on any item is determined on a prudent basis. So any item, any amount on any item on these financial statements are usually determined on a prudent basis, and we are also familiar with the prudence concept or principle, and we will look at the fact that only profits realized at the balance sheet date will be included in the profit and loss account, and all liabilities and losses which have arisen or are likely to arise in respect of the financial year to which the accounts relate or previous financial year are to be considered. Another thing is that all income and charges relating to the financial year to which the accounts relate shall be considered without regard to the date of receipt or payment. So in a nutshell, what we're basically seeing is if you have an expense that relates to this accounting period, whether or not that expense was paid in this accounting period, in the current accounting period, you must account for it and show it in the financial statements in this particular this current financial year that you're preparing the statements for. Similarly, if revenues were earned during the current financial year, you will record those revenues in this current financial year on the financial statements rather than in a future financial year. However, if you have those prepayments, then those prepayments will go towards the future financial statements rather than the current one that we are looking at. So these are, as I said previously, the accounting principles that I just explained to you are the concept of the going concern, the consistency concept, where you must be consistent in what you do in preparing these financial statements, the prudence and the accrual concepts, which you should already be familiar with. Now, at times, the directors can depart from the accounting principles that were mentioned. However, when they are looking to depart from these accounting principles, they must give the following in a note to the accounts. They must state the particulars of the departure. They must give reasons for the departure. Why are we departing from this particular way of presenting our financial statements? Why are we changing our depreciation method? So they have to give reasons for the departure, and also they must state the effect that the departure will have on the financial statements. What effect this departure from what I was doing previously would have on the financial statements. Notes to the financial statements. So you have notes to your accounts. So when we are preparing, you have notes to the accounts. So the following must be shown by way of notes to the accounts. One, the disclosure of the accounting policy. For example, what is the policy relating to depreciation? So that is one example. what is the policy relating to depreciation of the non-current assets? So that should be disclosed. Secondly, notes relating to the profit and loss account, like for example, how did you calculate your turnover? What did you do to arrive at your turnover figure? Things like the auditor's remuneration. So for example, when they talk about the auditor's remuneration, the amount shown must include the amount of auditor's expense, says paid by the company, things like taxation and particulars of staff. And when we talk about particulars of staff, what we are referring to things like what is the average number of persons employed by the company in that particular financial year. So those are things that are also disclosed when these are notes that are usually disclosed in the financial statements. And then also we will also have notes relating to the balance sheet. For example, our share capital, we will have notes relating to the share capital, and those notes will show things like authorized share capital. For example, that is what it will show. And we will also have notes relating to our fixed assets. So the various classes of the fixed assets or non-current assets will be shown at cost or revaluation where appropriate. So we will have notes relating to those as well. How did we arrive at the figures for the year? At the beginning, the additions during the year to the cost and the original cost. How did we come up with then the final figure that is there on our statement of financial position with respect to our non-current assets? Then we also have the director's report. And this report you have the directors usually prepare a report when the financial statements are being published, and the report accompanies the financial statement. And this report will contain a review of the business during the year and its position at the end of the year. For example, also what are the principal activities of the company during the year, and if there were any significant changes in those activities. So the directors will usually talk about what happened during the year with respect to the business and what activities they would have undertaken, and if there were any changes to the usual activities they will undertake during the year. Also, they will look at changes in the fixed assets or non-current assets during the financial year. Like for example, where the market value of land differs substantially from the value shown on the balance sheet. And so those are things that they will talk about, the changes in the non-current assets during the financial year. They will also look at important events affecting the company since the end of the previous financial year. They will look at those important events that would have affected the company during the financial year. So like for example, we are currently in a pandemic, and we will recognize that persons' sales revenue may fall, or persons may have to lay off their employees, and they may have to pay out severance, or those different things that may happen due to the fact that we are currently in the COVID-19 pandemic. So that may be an event that actually affects what goes on within the company during the year, and that is something that is important and noteworthy. So the director may want to speak with respect to that and how that impacted the company during the financial year, and the significant changes that it would have caused to the business during the year. Also, the directors may want to speak about the future developments in the business of the company. What are they going to look at in the future? How are they going to help the business to grow, to develop, be more profitable, how the business can look at it corporate and social responsibility and stuff like that. So the future developments in the business, those things the director report may also look at. They may also look at the company's activities in research and development. If they have a research and development department, they will look at what is going on within that department. They would also look at the amounts of any recommended dividends, any dividends that were proposed, or any transfers that were proposed to the various reserves that the company may have. Like, for example, the company may have a general reserve, a fixed asset replacement reserve, or a foreign exchange reserve. So they may speak about if they recommended dividends to be paid to the ordinary shareholders and what percentage or per share, dollar per share they were giving the paying the ordinary shareholders their dividends. And they would also talk about how much money out of the profits were transferred to the various reserves that the company may have. Also, they will speak about the names of persons who were directors of the company during the financial year. So let's say, for example, at the beginning of the year, you may have John Brown as a director of the company, but then by the end of the financial year, he's no longer a director of the company, may have moved on. So they will speak about those persons who were directors of the company during the financial year. They would also want to disclose any money that is given to charitable or political organizations, and I would believe that this disclosure, it will be based on the jurisdiction that you may be in, and what that jurisdiction requires, what figure that the donation has to be that is substantial enough that it requires the directors to speak about the fact that they would have given this particular charitable organization or particularly political organization this sum of money. They should also speak about the information regarding the security of the health, safety, and the welfare of the employees at work. What are they doing to ensure that their employees remain healthy, remain safe, and that the employees are not stressed to a level where they cannot function and prepare their duties. So they should speak with regards to that information with respect to the employees as well. So these are some of the things that may be in the director's report, and we will look shortly at what the auditor's report will contain. So the auditor's report, with respect to the auditors report to the shareholders, not to the directors. These are who the auditors are reporting to, the shareholders, not the directors. And in their report, they are going to state, in their opinion, because the auditor's report is usually in the auditor's opinion. So they're going to state whether, in their opinion, that the balance sheet or statement of financial position and the income statement or profit and loss account have been prepared in accordance with the requirements of the particular Companies Act. So they have to state that these financial statements were, in their opinion, prepared in accordance with the requirements of the various Company Acts. They would also state with that, in their opinion, that the balance sheet or the statement of financial position gives a true and fair view of the company's affairs at the end of the financial year. So they will go through, the auditors usually go through the financial statements, and that takes a while. So then that they have to present their opinion in their report and say, well, based on what we would have gone through, we believe that in our opinion, this is a true and fair view of what is happening within this company at the end of the financial year. Also, they will state the same thing with respect to the income statement or profit and loss account, and they will say that they believe that it gives, in their opinion, a true and fair view of the company profit or loss for that particular financial year. Now here we have a format of that we will be using. This is the format that we will be using for the income statement with respect to published accounts. So this is the format that we'll be using. And obviously, whenever you are doing published accounts, you must state, matter of fact, whenever you are preparing financial statements, you must state the name of the business that you are preparing the financial statement for. You must also state the type of financial statement you are preparing, like for example, income statement, and the period that you are preparing it for. So then you will see that this particular format has a condensed style. It is not like what we were accustomed to in doing our other financial statements. So it starts with our turnover. Then you subtract the cost of sales, or what persons will refer to as cost of goods sold, which would give us our gross profit. And from the gross profit, we will then subtract our distribution and administration expenses, and we will speak a little bit about what are distribution and administrative expenses shortly. And when we subtract that, that would usually give us our operating profit. So from that operating profit, we will subtract any interest that is payable and any other similar charges, but we would add our investment income. So if we receive like any income on the investments that the company would have made, that would add, and we would also add any interest that would have been received. So then after we would have done that, we will get something called our profit before taxation. So after we get our profit before taxation, then we will subtract our corporation taxes, which then gives us our profit after taxation. And below that, you have your income statement notes to the accounts. And those notes usually detail the various calculations, such as turnover, will then be written in that section. So you will have your income statement, a title income statement notes to the account, and those notes would speak about the calculations. How did we arrive at turnover? What figures we used to come up with our turnover? What figures did we use to come up with cost of sales? Which figures did we use to come up with our distribution and selling expenses? Which figures did we use to come up with our total administration expenses? Basically, that is what we're doing in the notes to the account section. So what are administrative expenses? Administrative expenses are the expenses that an organization incur. They are not directly tied to a specific function though, such as manufacturing, production, or sales. So obviously a business would incur various expenses during its financial year. However, when it comes to administrative expenses, these ones are not tied to a particular function. So they are usually office related. They relate to the organization as a whole. That's what our administration expenses usually relate to. They relate to the organization as a whole, as opposed to an individual department. So our administration expenses they do not relate to a particular department within the company. They relate to the whole organization. These particular expenses are usually fixed in nature. They're usually fixed in nature, which means when we say fixed in nature, they do not change usually from month to month, year to year, month to month per se. So they're usually fixed, and they exist regardless of the level of sales that occur within the company. So it doesn't matter how many sales revenue the company earn a particular year. They have to pay their office staff X amount in salaries and wages. It doesn't matter how much that they earn in sales for a particular year. They have to pay maybe the depreciation on, they have to expense the depreciation on the building. They have to pay their light. They have to pay their water. Those things that they have to pay, those various bills. So, and that does not matter the level of sales that occur during the year. The number of sales are irrelevant when it comes to these particular expenses. So now we've looked at administrative expenses. Let us look at distribution and selling expense. So what are our selling and distribution expense? These expenses are usually associated with the selling of a product and also the distribution of that same product to the end user. Okay, so the selling and distribution expenses are usually associated with the product that the business is selling and also how they go about distributing that product to the end user. So these selling and distribution expenses may include the salesman or salesperson salary and wages. They will probably include commissions that the persons may receive on those sales, things like maybe payroll taxes relating to those persons, travel and entertainment allowance. So for example, if the person has to go overseas to promote the product to get it sold, they may have to fly to another country, so that travel expense that is incurred would be associated with the selling and the distribution of the product. And they may have to go to a function where they are promoting the product. So also that's where the entertainment comes in, because they want to be able to get that product that belongs to the company sold. So they have to do various things to get it sold. So anything that is really associated with getting that product to the end user will fall under the selling and distribution expenses. Another one, for example, is the depreciation of the delivery vehicles. So you have delivery vehicles that are for the distribution, getting the product to the customer. So then any depreciation on those vehicles will fall under selling and distribution expenses. Finally, the final one that I have here is advertising. You do your various advertising to get the product out there for sale, so that will fall under selling and distribution as well. So where did I get all this information from? And the majority of this information was taken from the A-level accounting book by Harold Randall. And at this time, I just want to say thank you for taking the time out to listen to this short presentation on limited companies and published accounts. And we would like you to like our video and subscribe. Thank you.